Hello, everyone. Rob Wolf from Loan Factory, and you're listening to the Lone Wolf podcast, or you're watching me on my YouTube channel, the same name, the Lone Wolf podcast. That's loan spelled LOAN, as in borrow money. This is a video on interest rates and fees when you go shopping for a mortgage, and I'll get into that a little more detail later. But for some foundation, you can reach me at rob.wolf at loanfactory.com or call me on my cell, 727-366-5722. I always tell people I'm in the ABC business. Always be communicating. I'm available after 5 o'clock and on the weekend, so I'm not a bank. I'm pretty much 7 days a week. I am a licensed loan officer. Did you know that not every loan officer is licensed? Yeah, believe it or not. I'm licensed in Florida, where I live, Pennsylvania, where I grew up, and Colorado, the great Rocky Mountain state where I vacation every year. This podcast is just me. However, if you want to be a guest and you're in the real estate business, let me know, and we could do one together and promote your business. I try to keep these to under 30 minutes, most around 20. This might be pushing a 25-minute limit, and I post them on Wednesdays. But just go Google search the Lone Wolf podcast in case you miss an episode or you want to see an older episode. So today, what I want to talk about are interest rates and the fees associated with those interest rates when you, the borrower, go shopping for a loan. Because a lot of people don't understand there are fees that are subjective depending on the lender. So to get things started, let's say you're in that process. You're shopping for a home, and you might have an affiliation with your banker, and you want to get the interest rates. Now, there could be a credit union out there. There could be a private lender out there, or in my case, Loan Factory is a brokerage house. So for those that don't know what a broker is, kind of the middleman, that you come to me, and then I have over 100 lenders that I can choose the right loan package for you. Where some places it's just a cookie cutter, so to say, that they may only deal with 30-year fixed mortgages or whatever it may be. Loan Factory has other loans that can help you out. But for the most part, we're going to talk about 30-year fixed mortgages, FHA, and what have you in this video. So, you've already spoken to your bank. I highly encourage people speak to 2 or 3 different lenders out there. Now, I know what a lot of you are thinking. I don't want my credit score hurt. I'm just going to go with one place because I don't want my credit pulled 3, 4, 5 times and my credit score go down. Well, I'm not a big fan of the government. Whoever made this decision, but what they did was a good decision. That when you go shopping for a mortgage, now this is just mortgages, not any other loans out there. There's a 45-day window that you can get multiple credit pulls, and it counts as one hard credit pull. Okay, so that's why, because the people that made this rule realize people are going to be shopping around at different lenders to make sure they get the right, not necessarily the right rate, but also the right service that they're looking for. So you can get multiple credit pulls. Now, I will say that the average score is about 10 to 15 points where your score will go down with a hard credit pull. Okay, I've heard some people tell me, oh, mine went down 30, 40, 50 points. Well, there was something else in that 30-day period that adversely affected your credit score. Okay, so when you go and fill out applications with multiple lenders, just make sure it's within that 45-day window. Okay. So the first thing I want to talk about is the interest rate. And that's probably on most people's mind. That's the biggest, boulder that they want to take care of, because let's face it, that interest rate carries for 30 years. And a 1/4 point interest on a $300,000 mortgage over the lifetime of the mortgage, you're talking tens of thousands of dollars just in interest. Now, when you Google or you see advertisements, 30-year fixed mortgage, 6.5%, you may see in the fine print down below with a credit score of 740, 20% down, and you might see the loan amount, 200,000, 300,000. That's not everything that gets factored into your interest rate. Okay, so I'm going to go over, some of these items. And hopefully my mission here is to educate you so that you have the right questions to ask your lender. And feel free to ask me as well. Just send me an email. I'll be more than happy to answer any questions. So we've already mentioned the one as far as the credit score. Now, when I go into these not examples, but ingredients of your credit score and what have you, I want you to think of risk and reward. Okay. The lender is lending you money, the buyer, let's say $300,000 over 30 years. Okay, so what they're doing as part of the application process and figuring out your interest rates, they're looking, what is the risk to them? And is the interest rate justified for what they're going to charge you? If someone's in a high risk category, then they're going to have a higher interest rate because the lender feels that they need to be compensated because other loans like that may go south. Okay, so I don't know if that makes sense, but let's go through and I'll kind of explain it. So let's talk about a credit score. Okay, if someone has a 780 or higher credit score, that's kind of the gold standard with the mortgage field, and God bless those people. They paid on time, they've paid in full, they don't miss payments. They probably don't have multiple lines of credit meaning open accounts. There's some people that have 15 lines of credit. That's a little too much. So the people with the high credit score, they're disciplined. And that's what the lenders look for. If people are down in the 600s, and I think most people know this watching this video, if you're 620 or lower, you won't get a conventional loan. 620 is the absolute minimum. And 580 is the minimum for FHA. So if you're under 580, you're not going to get a loan unless you have about a 10% down payment. Okay, so credit score obviously plays a factor into that. The other item is your down payment. Okay, if someone's going to put 20, 25% down, as opposed to someone with 3% or 5% down, that 20% down payment person is going to get a lower interest rate. So why is that? Well, let's go back to our example of a $300,000 loan. If I put 3% down, that's $9,000. There's not much equity that I have in that property. So God forbid in 2, 3, 4 years, I lose my job and I can't pay the mortgage and I foreclose on the property. Well, the lender is going to have to go in, clean up the property. They're going to have to advertise. They're going to have to pay a seller's commission or a real estate commission. And all this is going to add up way more than $9,000. They're going to lose money, the lender. Okay, so they're going to charge a higher interest rate for that 3 and 5% down payment as opposed to the 20, 25%. If I put 20% down, that's $60,000. That means my loan's only going to be $240,000. In the same example, if I lose my job in 2 or 3 years, and I foreclose, well, the lender, okay, they'll go in there, they'll fix the property up or clean it up, whatever we're going to call it, advertise it, pay the real estate commission. They are still going to get more than that $240,000 loan amount back. So they're not going to lose money. So they feel that's less of a risk. They're going to give me a lower interest rate. Okay, does that make sense? Okay, couple other things. The type of house that you purchase or the property. If it's a single family house, that has a lower interest rate. If it's a condo or a manufactured home or an investment property like a duplex, triplex, or quad, they carry a higher interest rate. Now, why is that? Well, let's look at a condo. A condo, you're one unit of 200. Okay, the HOA has a responsibility to maintain the grounds of the property. What if the roof isn't kept in good repair? What if the outside, the siding or the paint job is not good? What if the parking lot has potholes everywhere? Okay, these are aesthetics that decrease the value of the property. So the lenders look at that and they say, you know what, a condominium has risk. And manufactured homes. Okay, I do a whole video on mobile homes, manufactured homes, and modular homes. But the gist is manufactured homes do not carry their value as well as single family homes. So you will pay a higher interest rate on a manufactured home. Okay. The type of ownership. Is this your primary house? You're going to be living there? Well, that's what they want. That gets the lower rate. Is this a second home? Is this an investment property? They carry a higher interest rate. Why do they? Well, let's go down the road of someone coming in financial trouble. If I have a primary house and I have a secondary home and I'm running into financial trouble, which loan do you think I'm going to not pay first? It's going to be the secondary home or the investment property. So that's why they carry a higher interest rate. The type of loan. Okay, is this a first-time homebuyer's loan, a down payment assistance loan, FHA, VA, conventional, a non-QM, non-qualified mortgage? All those different types of loans have different types of interest rates. Okay, your employment. Okay, the lender's looking for a 2-year snapshot of your most recent employment. Okay, if you're a W-2 employee with a very reputable company and you've got steady income, that's going to be viewed more favorable as opposed to someone that's had 3 or 4 jobs the last 2 years. Because that person with multiple jobs is seen a little more riskier to the lender. Okay. Now, the other thing is you can't have gaps in employment. Now, there could be a 1-week gap, 2 weeks, whatever it may be to get started with the next one. But any more than 2 weeks, that is going to be unfavorable and you may not get the loan. FHA is very strict on 2 weeks. Any more than that, that's going to be not viewed as favorable for you. Okay. So, and the other thing is make sure that it's earned income that we're looking at, not cash. The hospitality industry, that's a whole separate issue. We're talking about earned income for the employment. Okay. And speaking of income, your debt to income ratio. Okay. Real quick, as a loan officer, I look at this, they call the debt to income ratio. How much money do you bring in a month, gross income, versus the amount of debt that you're going to hold, including this mortgage, compared to that gross income? So, for example, let's say someone makes $60,000 a year. That's $5,000 a month gross income. Okay. Conventional and FHA, about 45 to 50% is the most debt you can carry. So let's just say it's 45%, that's $2,250. So this mortgage, plus your credit cards, plus your student loans, plus your medical bills, plus, did I say car payment? Okay, all your debt, and I get this when I pull your credit, gets factored in here. Okay, so if you're very close to that $2,250, as opposed to someone that makes $180,000 a year, their debt to income is not going to be near that 45%. It's going to be much lower, so they will get a more favorable interest rate. Okay, so hopefully all those fees wrapped up, or all those items, you see that plays a part in your interest rate. Okay, not huge. I'm not talking that someone's going to have a 6% as opposed to 8%, but these things could vary as much as a percent and a half. The big one is secondary home, investment property, and primary house at this time. Okay, so keep that in mind. Another thing to keep in mind is the service. And what I mean by that is underwriting. Ask your lender, do you have in-house underwriting? And in-house underwriting, Loan Factory has that. So if I've got a borrower that is not your traditional W-2 employee, an easy loan for lack of better words, maybe they are self-employed, they have income that fluctuates, I need some help figuring out their income on a monthly basis, they might have different jobs out there, whatever it may be. I can call our underwriters and they are experts at these scenarios, and they will guide me to say, let's get this, this, and this. If you take care of these items, you'll have to get documentation on A, B, and C. We'll be good to get to the closing table. Okay, the reason we do this up front is the worst thing we want is you purchase a house that I pre-approved you for. there were some things I didn't check out, and now we lock you into an interest rate, okay? And now the clock is ticking. And if we run into delays, that could cause us to go past the closing day, okay, which the seller doesn't want. Nobody wants to do that, okay? And speaking of locking in periods, that was another thing I didn't mention on your interest rate. Traditionally or typically, a loan officer will lock you into a rate for 30 days. Okay, that gives us 30 days to get to the closing table. Most of the time, that's not a problem. However, maybe you want to do a 45-day lock or a 60-day lock. That will be a higher interest because the lender, you're buying time by more than 30 days. Okay, now you can get a better rate with a 20-day lock, but that's a little tough to accomplish. But so keep that in mind. And I will say this, I'll go on a little tangent here. Manufactured homes, there's a lot of inspections that have to get taken care of. So if you're looking at a manufactured home, I would look at the 45-day lock. Okay. Again, if you have a contract for a certain date and you don't meet it, then to extend the lock, you will have to pay a penalty. And depending on who's at fault, it could be the buyer, you that didn't get documents in a timely manner, or it could be somebody else. Okay, so keep that in mind. Okay, now let's talk about fees. This is the part that a lot of people have trouble with or they don't quite understand it. So I'm going to go over, this is in section A of your CD, your closing disclosure, your LE, loan estimate. And you will receive this when you get locked in to your interest rate. Well, how do you know what these fees are before you get locked in? You ask. You can ask your lender as you're talking and you get pre-approved, and you'll be doing a hypothetical. If I have a $300,000 loan, can you send me what my fees would be? And they will do that. They should. If not, that might be a red flag to you. Now, there are some brokers out there that don't have the sophistication to get you a fee sheet, but you should find someone that has a fee sheet so that you can look at the different lenders you're dealing with to make sure you're doing an apples to apples comparison. Okay, now the fee sheet, the LE, the CD, they're all kind of a catch-all, the same thing. Now, a lot of the charges are not going to vary depending on the lender you go with. Okay, you're going to have to pay an appraisal, the real estate taxes, your homeowner's insurance, the recording fees. Okay, all those, they're not going to change much. Okay, the one I want you to be concerned with is section A. And you're going to see in that section underwriting fee, could be origination fee, could be brokerage fee, could be processing fee, could be points, or any other add-on. So what I'll talk about those in general, and then I'll show you how they play into this as well. So when you talk to your banker, your lender, you ask them, what is your underwriting fee? They should be able to tell you this without any hesitation. Most underwriting fees are $1,000 to $1,600. I've seen some higher than that, and those are non-QM, non-qualified mortgages. Those are not the 30-year fixed rates we're talking about by Fannie Mae and Freddie Mac. Banks are usually around $1,500. Loan Factory has a relationship with Rocket Mortgage. We get underwriting for $1,050. Okay, that would be disclosed to you. A brokerage fee or origination fee, okay? Because I work for a brokerage, Loan Factory needs to get paid. And this can be anywhere from 1 to 2.5% of your loan value. Typically, the lower the loan amount, the higher that percentage would be, and vice versa. If you have a high loan amount, $500,000, then you'll be around that 1%, depending on the loan officer or the loan company. Okay, so these are things to keep in mind. Processing fee, about $1,000. Okay, so you want to see, are you going to have to pay for that, the buyer, or will the lender pay that? Okay, lender credits, because I'm a broker and I charge that brokerage fee, I am able to get lender credits from Rocket Mortgage or any other lender, and that is disclosed. And I'll show you an example of that. And that helps compensate for that brokerage fee. And sometimes I can get some more money to help you out on the brokerage fee and other fees attached. Okay. So let's say I'm shopping around for you. The first example I want to do is tell you about buying down a rate. Because some people ask me, I pick up the phone and they say, hey, yeah, what's your rate? I don't even know this person's name. I have no information whatsoever. They want to know the rate right away. And as I discussed earlier, there's so many factors that go into it. Okay, but the gist is I can give you any rate. Are you willing to pay for it, to buy down the rate, or do you want a credit for a higher interest rate? Okay, let me explain it this way. The lender, and let's just say $300,000, right about now, the time of this filming, let's say 6.5%. I think it's a little bit lower, but let's say if they charge 6.5% off of $300,000 over 30 years, they feel they're going to make a profit. Okay, that's what the going rate is. Yet, if you want a lower rate, okay, let's say 6%, they're not going to make as much money over the life of the loan. So how do they get paid? They make you pay. You buy down. You pay extra money to buy down that rate. Okay? So what I'll do, let me change screens here for you real quick, and I'll show you what I mean. And I'll go through this exercise with people just to see and just to show them if it's worth it or not. So in this example, we have 6.375%. I'm going to try to visualize this for my folks on the podcast because they can't see the screen. So we have a 6.375% interest. It costs $192, and your monthly payment would be $1,872 for principal and interest. If you wanted to buy down, get a lower interest at 5.99%, it would cost you $2,886. But your payment would be $75 lower, which is $1,797. So what I do in cases like this, I talk to buyers, and first we got to find out, what is your break-even point? Okay, you're going to pay money, but is it going to be worth it, and how long? So I take the $2,886, I subtract $192, and divide that by that $75 difference. Okay, and that comes up to about 36. It's just under 36. Well, what's that number represent? That's the number of months that you're in that house paying that mortgage until you break even. Okay, so I asked them, are you going to be in this house more than 3 years, you think? And they say, oh yeah, this is our forever home. Okay, then it might be worth it if you want to pay that fee. Now, they could say, no, I'll just refinance if the rates get down under 6%, whatever it may be. But things to consider when you're talking to your lender, why you may not be there for 3 years. Maybe you're dating somebody. You're going to get married and you're probably going to buy something else with your partner. Maybe you're here on a job and you think you're going to get transferred in a few years down the road. Okay, then this may not be a fit. But anyway, keep these in mind because honestly, I'm surprised how many borrowers I talk to and they say my lender didn't talk about these things to me, and not all do. Okay, so keep that in mind. And lender credits. Let me show you that screen. This was one that I had a little while ago, a lender, and I was able to get her, a certain rate, and I'm going to be able to scroll. So right here, the top line, broker compensation. That's what Loan Factory got paid. It was $33.15. And on the right-hand side, I don't know if you can see my arrow, but all these charges on the right, they would have been right here in the column borrower paid. But like I said, these are lender credits that Rocket was able to give. And when you scroll all the way down, it was $35.38 and 21 cents. So it's $3,538 in lender credits. The brokerage fee was $33.15. So that paid for all of the broker's comp. Okay. And then all those other fees. So that's what you want to ask. If you're dealing with a broker, are they able to get you, lender fees, lender credits, and ask them? They should be able to get you in the ballpark. Okay. Let me change one last screen, and I'll show you if I can find it in here what we were talking about, so you can take a screenshot. I can't do this in a Word document. Let's see here. Hold on a second. Bear with me. And these are just the fees that we were talking about. So we got underwriting fee. You want to ask your lender, what's your underwriting fee? And if they can't tell you, that's a red flag. Okay. If it's a brokerage house or some other lender, ask what's their origination charges. Is there a processing fee that you have to pay? Are you paying for any points or paying a fee to buy down that rate? You want to check that out. And like I said, ask if there's any lender credits that will offset that brokerage fee. Okay. So hopefully this gave you a good feel for what to ask your lender or lenders when you're out shopping for mortgages. Okay. If you have questions, give me a call, give me an email. I'll be more than happy to give you some guidance and direction, but hopefully this is a good blueprint so that when you do talk to multiple lenders, you will be comparing apples to apples and not get caught up in, all that other stuff. Okay. So again, rob.wolf at loanfactory.com. My number is 727-366-5722, or just hit reply and I'd be more than happy to answer any questions for you. All right, folks, I made it under the 30-minute mark. I hope this was educational. And again, I'll see you on the next podcast or the next YouTube. All right. Take care, folks.